Welcome, and thank you for participating in the Wisconsin Credit Union League's training on Bank Secrecy Act and OFAC compliance. My name is Paul Guttormson, and I'm the VP of Legal and Compliance for the League. These webinars are designed to give credit union staff an understanding of what federal regulators require credit unions to do in order to comply with the Bank Secrecy Act and with Office of Foreign Assets Control or OFAC rules. The League offers a separate and shorter webinar for credit union boards of directors, giving them a high-level overview. We've divided the material into 3 parts. This is a roadmap of the topics this BSA OFAC webinar series is designed to cover. This webinar is part 2, which is highlighted in red. We focus on completing the 2 required reports that credit unions must file under Bank Secrecy Act: the Currency Transaction Report and the Suspicious Activity Report. Then we take a closer look at customer identification programs and customer due diligence, requirements that help you understand who your members are and to identify those who may be higher risk. In part 1, we talked about the 5 pillars of BSA compliance. One of those pillars is internal controls, and that includes having policies and procedures in place to be sure the credit union completes and files timely, accurate reports when required by BSA. One of the reports that your credit union is required to file is the CTR, or Currency Transaction Report. Anytime someone makes a transaction in currency of more than $10,000, the credit union has to report it to the Federal Financial Crimes Enforcement Network, or FinCEN, which is part of the U.S. Treasury. Currency means coin and paper money. The credit union does not need to file a CTR for a transfer by check or wire transfer, even if it's more than $10,000, because that does not involve currency. A transaction in currency could involve cash deposits and withdrawals from any account, checking, savings, an IRA, and so on. But other transactions might involve currency changing hands too. For example, someone making a cash payment on a loan, a member or a non-member cashing a check over the counter, denomination exchanges where someone exchanges small bills for larger ones or vice versa. Those are all examples of transactions that could trigger a CTR. When deciding if a transaction triggers a CTR, add debits to debits and credits to credits. You don't set them off against one another to arrive at a net figure. So for example, if someone makes a cash deposit of $8,500 and makes a cash withdrawal of $6,000 the same day, those transactions are not subject to CTR reporting. Consolidate cash in and cash out separately. The credit union must file a completed CTR with FinCEN within 15 calendar days after the date of the transaction. CTRs must be filed electronically through FinCEN's secure BSA e-filing website. The credit union must keep a copy of the CTR for at least 5 years. If your credit union fails to file CTRs on reportable transactions, then it should start filing CTRs from that point forward and should contact FinCEN's regulatory helpline, asking them to determine whether the backfiling of unreported transactions is necessary. Of course, most criminals know better than to deposit more than $10,000 at one time, so they split their transactions up, trying to avoid detection in the filing of a CTR. The federal rules say that a credit union must aggregate or add together multiple transactions that total more than $10,000 in one business day. The FFIEC's BSA exam manual says, and I'll quote, "Multiple currency transactions totaling more than $10,000 during any one business day are treated as a single transaction if the bank has knowledge that they are by or on behalf of the same person." That's a key phrase, by or on behalf of the same person. Let's look at some examples of what that means. Suppose the credit union knows that Company A and Company B have the same owner, operate out of the same address, and continually commingle funds between their separate accounts. The credit union might decide, based on this information, that they aren't really independent of each other. One day, an employee of Company A deposits $6,000 into Company A's account. Later the same day, an employee of Company B deposits $5,000 into Company B's account. The credit union should file a CTR listing Company A and Company B in separate sections, identifying the persons on whose behalf the transaction is conducted, and listing a cash-in deposit of $11,000. Another example is this. Suppose you have one member who has access to multiple accounts. He's the authorized signer on a business account. He has his own checking and savings accounts. He is a custodian for his child's account. He's a POA on his grandmother's account, and he's a guardian for an account in his wife's name. He deposits $5,000 cash into each of those separate accounts. That's a transaction by a single person, even though it's on behalf of other people. So you need to aggregate all of those transactions together and file a CTR, showing that they were done by one transactor. The credit union also needs to watch for a series of smaller transactions over time. Let's say a member brings in $6,000 one day and $6,000 the next. Neither one on its own would trigger a currency transaction report because they're made on more than one business day. But those deposits might lead you to believe that the member is intentionally splitting deposits into smaller amounts just to avoid a CTR filing. That's called structuring. Federal law prohibits the structuring of transactions to avoid currency transaction reporting. Your credit union needs some system to aggregate transactions and to watch for structuring. What you do depends on your risk level and your credit union's resources. Your data processing system might be able to run reports that show all currency transactions of more than, say, $3,000. You can have the BSA officer review that report every day to look for patterns that could indicate structuring. Larger credit unions may need automated software to look for suspicious patterns. However, two transactions slightly under the $10,000 threshold conducted days or weeks apart may not necessarily be structuring. Don't automatically assume it's structuring. Instead, further review and research may be needed. If staff suspects structuring, they should report it to the BSA compliance officer, who can determine what reporting, if any, is needed. Finally, be aware that it's illegal to assist in structuring. So tellers and other staff should never suggest that a member break up a large deposit, even if it's just because they want to avoid the trouble of completing a CTR form, or because the transaction appears to be innocent. So you have to file a CTR for transactions by or on behalf of one person. What if the cash transaction involves a joint account? Is that on behalf of both joint account holders? FinCEN has stated that when a large deposit is made to a joint account, it is considered on behalf of all joint account holders, since all of them have access to the money. So FinCEN says that all joint account holders must be listed on the CTR. If the cash transaction involves a withdrawal from a joint account, only the account holder making the withdrawal is reported, unless the credit union has actual knowledge that the withdrawal will benefit other account owners too. Some businesses have legitimate needs to handle large amounts of cash on a regular basis, like convenience stores. The credit union can exempt them so that CTR reports won't be needed every time they bring in cash. A credit union can choose not to grant exemptions, but if it does, then it does not need to file a CTR even when large currency transactions are made on accounts those businesses own. The BSA rules have two groups of exempt businesses. The first group is financial institutions, government groups, and publicly traded companies. Those are referred to as Phase 1 exemptions. No special filing is needed to make them exempt, except that exempting a publicly traded company does require a filing. Second, certain kinds of businesses can qualify for a Phase 2 exemption if they meet three requirements. 1. Having a transaction account at the credit union for at least 2 months. 2. Making currency transactions at least 5 times a month. And 3. Being incorporated or organized in the United States. Some kinds of businesses cannot qualify for a Phase 2 exemption. The regulations have a list of such businesses, and they include car dealers, pawn shops, and professional service providers like law firms. Businesses that aren't on that list, which are referred to as non-listed businesses, can be exempted if the business meets those 3 requirements I mentioned. If the credit union wants to grant an exemption to a publicly traded company or to an eligible business under Phase 2, it has to file a Designation of Exempt Person form. The credit union no longer has to renew that filing every year, but it does have to verify every year that the business still qualifies for the exemption. The other type of reportable transaction under BSA is the Suspicious Activity Report, or SAR. A suspicious activity report is used to report suspected money laundering type activity or other suspicious situations to the government. Your credit union must file a SAR when staff suspects a violation of federal law, possible money laundering, and so on. If the suspicious person is a credit union employee, in other words, an insider, it doesn't matter how much is involved. FinCEN wants to know about it. Beyond that, though, not every small transaction justifies doing a SAR. A SAR is required if you can identify a suspect and more than $5,000 is involved, you can't identify a suspect and more than $25,000 is involved, or if more than $5,000 is involved and the transaction may have to do with potential money laundering or crime, it's designed to evade the Bank Secrecy Act, or it has no apparent purpose or is not ordinary for the member and the credit union has no reasonable explanation for it. Even if activity is below these dollar thresholds, the credit union is still allowed to file a SAR anytime it feels activity is suspicious. The regulators refer to this as discretionary reporting. Ordinarily, state and federal confidentiality laws would prohibit the credit union from sharing information about its members, even with law enforcement. Now, there are exceptions, of course, such as where you're served with a subpoena or a warrant. But federal law provides a safe harbor for credit unions who file SARs. The credit union, its staff, and its management are protected from civil liability for all reports of suspicious transactions made to appropriate authorities. The safe harbor protects you whether the activity is over those dollar thresholds or below those amounts. We talked about internal controls being one of the pillars of BSA compliance. The FFIEC exam manual says suspicious activity monitoring and reporting are critical internal controls. Your credit union needs to have procedures in place to spell out how it will look for suspicious activities. This depends on your assessment of risk. We talk about the importance of the BSA risk assessment in part 1 of this webinar series. The higher your risks, the more sophisticated your monitoring system needs to be. At a minimum, staff members need to know who to go to at the credit union if they think a transaction is suspicious. Getting a request for information from law enforcement could also trigger SAR monitoring. If you get a 314A request about a member, or a warrant, or some other indication that law enforcement wants to know about a member, that may lead the credit union to examine that person's accounts more closely for suspicious activity. Also, your BSA officer can review various data processing reports to look for unusual patterns that might reflect illegal activities. That's called manual transaction monitoring. Examples of reports that might be reviewed include currency activity reports, funds transfer reports, monetary instrument sales reports, large item reports, significant balance change reports, ATM transaction reports, and non-sufficient funds reports. Many data processors can filter the reports to help you focus on unusual activity or activity over a dollar threshold that you can set. Your credit union might review daily reports, reports that cover a period of time, like a rolling 30-day report or monthly report, or a combination. Larger institutions with more resources and more sophisticated systems might use an automated account monitoring system, which can automatically scan activity to help spot anything potentially suspicious. Appendix F of the FFIEC's BSA exam manual has examples of potentially suspicious activities or red flags for both money laundering and terrorist financing. The lists are not all-inclusive. They're just examples to help credit unions and examiners recognize possible money laundering and terrorist financing schemes. I'd urge you to read through that appendix for details. We can't cover it all here, but I want to mention the highlights for you to give you a flavor of things to be aware of. Customers who provide insufficient or suspicious information. This could include a customer or member using unusual or suspicious identification documents that cannot be readily verified, or someone who uses different taxpayer ID numbers with variations of his or her name. Efforts to avoid reporting or record-keeping requirements. This could mean a member who tries to persuade credit union staff not to file required reports like CTRs or maintain required records, or someone who structures their cash transactions to be just under the thresholds for CTRs, or someone who deposits funds into several accounts, usually in amounts less than $3,000, and then consolidates it all into one account, and then maybe transfers it outside the country. Activity inconsistent with the customer's business. Signs could include currency transaction patterns that suddenly change in a way that's inconsistent with normal activities. It could also include a business with cash transaction patterns that are different from similar businesses in the area. Suspicious lending activity. Your lending staff have to be aware of money laundering too. For example, loans secured by collateral that's owned by third parties who are unrelated to the borrower, or loans someone takes out for the benefit of a third party without some reasonable explanation. Cash purchases of vehicles can be a red flag too. Suspicious activity by employees. That could mean an employee who has a lavish lifestyle that cannot be supported by his or her salary, or someone who's reluctant to take a vacation, possibly because that would prevent them from making continuous transactions to support some kind of fraud. Other unusual or suspicious customer activity could mean all sorts of things, like a member who frequently exchanges small bills for large denominations, a member who often deposits currency wrapped in currency straps or rubber bands that's disorganized. It does not balance when counted. Or a member who buys a lot of cashier's checks, money orders, or traveler's checks for large amounts, or who buys a lot of open-end prepaid cards for large amounts. When you fill out the SAR form, the narrative section is critical. You're reporting possible crimes, so give law enforcement authorities enough to go on so they can decide whether it's something that warrants more investigation. The narrative needs to include details and explain why you're reporting the activity. You want to answer who, what, when, where, why, and how. Who's involved? What happened? When it happened? Where did it happen? How did it happen? And why is the activity suspicious? A SAR must be filed no later than 30 calendar days after the credit union initially detects the suspicious activity. If no suspect is identified on the date of detection, the credit union may take up to 60 calendar days to identify a suspect before filing. If the suspicious activity is ongoing, the credit union may monitor suspicious activity during the 90-day review period and, if warranted, file an ongoing SAR within 120 days after the one previously filed. Just like the CTR, the SAR must be filed electronically, and any supporting documentation has to be kept for 5 years. Whether to file a SAR is a pretty subjective decision. What may seem suspicious to one person may not to another. Your credit union should document its SAR decision-making process. If staff brings potentially suspicious activity to the BSA officer's attention, the BSA officer should keep notes of what he or she does to investigate the activity. If the officer decides not to file a SAR, those notes should explain why not. That helps the credit union defend its decisions if examiners or law enforcement later question why the activity was not reported. The board of directors must be informed about any SARs the credit union files. They don't need to be told every detail, though. It might be best simply to tell the board about the number of SARs filed during the month and then summarize the reasons for filing them. Finally, SARs are confidential. No one at the credit union, including directors, should tell anyone else about the suspicious activity that's been reported. Staff should not discuss SAR filings with anyone except their BSA compliance officer and/or their manager. However, appropriate law enforcement agencies may request a copy of a SAR and any supporting documentation for an investigation, and it's okay to give it to them. Next, we'll go through the legal requirements for your credit union's Customer Identification Program, or CIP. Every credit union must have a written Customer Identification Program, CIP, that's appropriate for its size, location, and type of business. We explained in part 1 of this webinar series that your BSA program should be risk-based, and the same holds true for your CIP program. For example, are you located in a large metropolitan area designated as a high-intensity drug trafficking area? Do you have a community or closed charter? Do you offer electronic services such as internet banking and wire transfers? Do you allow accounts to be opened through the internet or mail? Do you operate several branch locations? Whatever your answers, your CIP procedures need to adequately cover those types of risks. The CIP program for a billion-dollar community-chartered credit union located in a high-intensity drug trafficking area is naturally going to be different than for a $10 million closed-chartered credit union in a rural area. Knowing your members is a credit union's most effective weapon against unwittingly being used to launder money or support terrorist financing or other crimes. On this slide, you can see the required components of a customer identification program. Your procedures must ensure that you obtain the required minimum information about each prospective member. We'll talk about that in more detail in just a minute. In addition, you must have procedures to verify the identity of each member. You must create a record of this information and retain both the required information and a description of the identity verification method used. I'll be focusing on these 4 items on the list. The regulations also technically require you to check the names of all members against any government list of known or suspected terrorists. At the time the CIP rule was being written, the regulators anticipated creating a list, but it's never been done. And the 6th item on the list, if applicable, you'll need to include procedures specifying when the credit union may rely on another financial institution to perform any procedures of the credit union CIP. That's seldom an issue, so we won't spend time on that. The CIP rules apply to accounts of customers. An account is defined as a formal banking relationship, established to provide or engage in services, dealings, or other financial transactions. It includes deposit accounts, transaction or asset accounts, loans and other forms of credit, safe deposit box rentals, safekeeping services, cash management, and custodian and trust services. An account does not include check cashing, wire transfers, or the sale of checks or money orders if no formal banking relationship is established. Or an account opened for the purpose of participating in an employee benefit plan. Or accounts that the credit union acquires through an acquisition, merger, purchase of assets, or assumption of liabilities from any third party. A customer under CIP is an individual or legal entity that's opening a new account with the credit union. Customer also means an individual who's opening a new account for another individual who lacks legal capacity, such as a minor or a legally incompetent person, or for a group that has not formed a legal entity, such as a sunshine club or bowling league. In the case of joint accounts, it means each account holder. Joint account holders don't necessarily have to be members of the credit union in their own right, but that doesn't matter for CIP. They're still considered customers, and CIP is still required to verify their identities. What about authorized signers on business accounts? They're not technically customers because they don't own the account. The business owns it. They're just authorized to access it. Regardless, it's considered a best practice to perform CIP on them as well. A customer does not include a person with an existing account, provided the credit union has a reasonable belief that it knows the true identity of the customer. So if someone has already been CIP'd at your credit union, unless you have a reason to doubt their identity, you don't have to repeat the process when they open a new account or sub-account. A customer also does not include financial institutions regulated by federal or state bank regulators, government agencies and instrumentalities, and companies that are publicly traded. Before you implement your customer identification program, you must provide a notice that you're collecting information. The regulators provided a model notice that everyone is probably using. The model simply states that in order to fight the funding of terrorism and money laundering, federal law requires all financial institutions to obtain, verify, and record information that identifies each person who opens an account. The model notice should be posted where new accounts are opened. For example, you might place a notice in the lobby and the new accounts office. You might also post the notice on your website if you accept membership applications online. Remember the broad definition of accounts. It includes deposit accounts, credit or loan accounts, safe deposit box rentals, and more. You might say that there are 4 steps in the CIP process. Let's take a look at these steps one at a time. The first is to collect information. The CIP rule sets minimum standards, and you can always build on this, but you cannot accept less. You are required to obtain the customer's name and address. The address needs to be a physical address. You can always mail statements to a post office box, but an actual street address has to be on file. Also, you need to collect the date of birth for individuals. For U.S. persons, the identification number must be their taxpayer ID number. This will be a Social Security number for individuals and an Employer Identification Number, or EIN, for organizations. For non-U.S. persons, the identification number might be a Social Security number, EIN, or ITIN. For those of you not familiar with ITINs, it stands for Individual Taxpayer Identification Number. And the format is the same as a Social Security number, but starts with 9. The IRS issues ITINs to individuals who are required to have a U.S. taxpayer identification number, but who do not have and who are not eligible to obtain a Social Security number. Individuals must have a filing requirement and file a valid federal income tax return to receive an ITIN, with some exceptions. There are some foreign persons who do not qualify for a U.S. TIN. In those cases, you can accept a different number, such as the number off of a valid passport, an alien identification card, or any other unexpired government-issued ID that shows the person's nationality, country of issuance, and photograph. An example might be a matricula consular. This is a document issued by the Mexican government. The second step is to verify identity. Your CIP must include procedures for verifying the identity of the customer using identifying information obtained in Step 1. A credit union does not need to establish the accuracy of every element of information it obtains, but it must do so for enough information to form a reasonable belief that it knows the true identity of the customer. If you encounter any discrepancies, you must resolve them before moving on. Let's say, for example, that a person gives you a driver's license for ID, and the address on the card does not match the address provided. There may be an obvious reason, such as the person has recently moved. To resolve this, you might ask for a recent utility bill in their name that shows their current address. If discrepancies cannot be resolved, consider whether a SAR should be filed. There are 2 ways that credit unions can verify identity: documentary verification and non-documentary verification. Your credit union's CIP policies and procedures must address what methods you'll use and in what circumstances. Your procedures must describe when the credit union will use documents and list the documents that it will use. These documents may include, for example, for individuals, an unexpired government-issued identification document evidencing nationality or residence and bearing a photograph, such as a driver's license or a passport. A Treasury ruling says that if an elderly or disabled customer does not have the normally acceptable forms of ID, the credit union may accept a Social Security, Medicare, or Medicaid card, along with another form of documentation bearing their name and address. Additional forms of documentation include a utility bill, a tax bill, or a voter registration card. The alternative forms a credit union decides to accept should be included in its policies, procedures, and processes. For corporations, partnerships, trusts, and groups other than individuals, you can use documents showing the existence of the entity, such as certified articles of incorporation, a government-issued business license, partnership agreement, or trust instrument. The credit union's non-documentary procedures must address situations where the credit union is not familiar with the documents presented, or the document is expired, the account is opened without obtaining documents, or the account is not opened in person, for example, via the telephone, mail, or the internet. The procedures then have to describe the non-documentary methods the credit union will use to verify identity and when they will be used in addition to or instead of relying on documents. Non-documentary methods may include independently verifying identity by comparing information provided by the customer with information obtained from a consumer reporting agency, a public database, or other source. Wisconsin has a helpful resource for non-documentary verification on organization accounts, the Department of Financial Institutions Corporate Registration Information System, or CRIS, C-R-I-S. Most organizations, with the exception of sole proprietors, general partnerships, and some unincorporated associations, must register with the DFI to be formed under Wisconsin law or to do business in this state. CRIS is a database that contains information about the date the organization was formed, its standing with the DFI, and contact names and addresses, and this is all available at no charge. The CRIS system is very helpful in confirming the information already provided. It's also helpful as an early warning sign. For example, let's say that you have a request for membership from a Wisconsin LLC, but you can't find a match on CRIS. That may mean the LLC never registered, or that you have the incorrect name. Let's say that you get a match, but you discover that the organization is in bad standing with the DFI because they haven't filed required annual reports. The organization may be legitimate, but do you want to do business with them given their lack of good standing with the DFI? You can actually use the DFI site to order copies of the documents that were filed to create an organization in Wisconsin, like articles of incorporation. Those would be documentary methods of verifying identity. Your credit union's CIP procedures must provide for making and maintaining records of all the CIP information you obtain. The regulations provide for a two-part record retention schedule. First, for the identifying information you collected, such as name and street address, the rules say that the credit union must retain the information for at least 5 years after the date the account is closed, or in the case of credit card accounts, 5 years after the account is closed or becomes dormant. Second, you also have to record information about how you verified identity. In other words, what documents you examined or what non-documentary methods you used. The rules say that the credit union needs to retain those records for 5 years after the record is made. It's safest just to keep it all for 5 years after the account is closed. CIP rules do not require credit unions to retain copies of driver's licenses or personal identification cards. The rules only require credit unions to, quote, record a description of any documents that were relied on, noting the type of document, any identification number contained in the document, the place of issuance, and, if any, the date of issuance and expiration date. Many credit unions scan IDs, though, rather than manually recording the information from them. Copying or scanning the identification card counts as recording the information, but BSA regulations do not require it. In the last section of this webinar, we cover customer due diligence. In part 1 of this series, we told you there were 5 pillars of BSA compliance. CDD is the 5th of those pillars. These rules became effective in 2018, but even before that, FinCEN has said that it expected credit unions to exercise CDD when opening accounts and monitoring accounts for suspicious activity. These CDD rules essentially codified FinCEN's previous guidance, turning it into a binding regulation. There are two aspects to CDD. The first aspect has to do with risk profiles and monitoring accounts for suspicious activity. The CDD rules say that your credit union must put appropriate risk-based procedures in place to help you do three things. 1. Understand the nature and purpose of customer relationships so that you can develop customer risk profiles, which lets you focus your monitoring on higher risk customers. Our II release on CDD has sample risk rating matrices. 2. Conduct ongoing monitoring to identify and report suspicious transactions, and, on a risk basis, maintain and update customer information. And 3. Conduct enhanced due diligence on members you determine are high risk. This means monitoring their accounts more closely for suspicious activity. The second aspect of CDD can be called the beneficial owner rules. They say that you must gather information to identify the beneficial owners of legal entities that belong to your credit union. In other words, you need to take steps to help sort out who actually owns and controls those businesses. This slide covers the first aspect of the CDD program that I just mentioned. Regulators expect your credit union to gather information at account opening, not just to identify members as part of CIP, but also to develop a risk profile. And to do that, you need to understand what level of normal activity to expect for the member's occupation or business operations. That way, you have a baseline to measure against when trying to determine if someone's activity is suspicious or out of the ordinary for that member. To create a risk profile, you have to assess a variety of factors, which may include the type of account and its size, the types and frequency of transactions, the country of residence of the account's owners or its beneficiaries, and the source of their funds. FinCEN says that the customer risk profile may include self-evident information, such as the type of customer or type of account, service, or product. Our II release on customer due diligence, number 0159, has two risk matrices, one for individuals and one for organizations. They can be used to help your credit union gather information and assign risk ratings. The credit union should also have procedures in place to keep its CDD information up to date. When the credit union finds information about the member in the course of its business that is relevant to reevaluating the risk posed by that member, it must update the member information and risk profile. That could include, for example, a significant or unexplained change in the member's activity, such as executing foreign wire transfers for no apparent reason, or a significant change in the volume of activity without an explanation. Finally, your policies and procedures should provide for staff to identify, at account opening, members that pose a heightened risk for money laundering, terrorist financing, or other illegal activity. If such members are identified, then you must apply what the FFIEC calls enhanced customer due diligence. This helps the credit union with allocating its limited resources. You can't watch every account, so try to identify the higher risk members and give their accounts extra attention as you monitor for suspicious activity. The rest of our discussion on CDD will focus on the beneficial owner rules. As I said, the rules require you to gather information to identify the beneficial owners of legal entities that belong to your credit union. What legal entities is this rule referring to? Basically, it means organizations that are separate legal entities, distinct from their owners. The term legal entity customer means a corporation, a limited liability company, or any other entity that is created by the filing of a public document with the Secretary of State, or whatever similar office a state may have for filing corporate records. And in Wisconsin, that's the DFI, the Department of Financial Institutions. It also includes a general partnership and any similar entity formed under the laws of a foreign jurisdiction, that is, another state, that opens an account. In other words, the rules apply to most organizations. However, the definition does not include sole proprietorships, unincorporated associations like scout troops and youth sports leagues, or natural persons opening accounts on their own behalf. This makes it clear that the rules only apply to organizations, not personal accounts. The definition also exempts certain types of organizations because information about their ownership and control is available from other sources. For example, a department or agency of the federal, state, or local government is not a legal entity that is subject to these beneficial owner requirements. Are trusts included in the definition of legal entity customer? Not usually. The definition of legal entity customer only includes statutory trusts created by a filing with the Secretary of State or similar office. Nearly every trust the credit union sees is created simply by signing a declaration of trust, with no need to file it with a state office in Madison. Only so-called common law or statutory trusts, which are business trusts, are created by filing required paperwork with the state. They're governed by Chapter 266 of the statutes, and it's rare for credit unions to encounter these. Whenever a legal entity customer opens an account, including a new sub-account if the organization is an existing member, the credit union must identify its beneficial owners. And that means the natural persons, legal speak for human beings, that own or run the company. The CDD rules have a two-pronged definition of beneficial owners, with an ownership prong and a control prong. Under this approach, the credit union must identify each individual who owns 25% or more of the equity interests in the legal entity customer, although credit unions are permitted to set a lower percentage threshold if they want. And you must also identify at least one person who has significant responsibility to control the legal entity, such as senior management or another person who regularly performs similar functions. Each prong operates independently. This means that a credit union would be required to identify and verify the identity of any person who satisfies either prong. There can be some overlap, so that same person may be identified under both prongs. If no one owns 25% or more of the organization, then the credit union can instead just identify a beneficial owner under the control prong, without having to identify any owners under the ownership prong. A credit union can identify the beneficial owners of an organization by obtaining a certification regarding beneficial owners of legal entity customers, a standard form that's provided in the rules. We've attached it as an exhibit to our II release number 0159, and it's available electronically from FinCEN as well. You also have the option of 1. Designing your own forms if they meet the rule requirements, or 2. Obtaining the required information by any other means, so long as the person opening the account and providing the information certifies that it's accurate. We think it's easiest to use the standard form. But note that using the form is optional. The credit union gains no protections from liability by using that form. The form shows the name of the person signing it, and for each person who meets either the ownership prong or the control prong, it will list their names and title, date of birth, address, and an ID number, usually a Social Security number. Who from an organization would be qualified to complete a certification form? In most cases, it'll be the same person who's named in an account opening resolution, such as the league's depository declaration and agreement, as the person authorized by the organization to open its accounts. They are expected to know who owns and runs the company. So the credit union doesn't have to play detective and sort out who owns and controls the company. The person opening the account should be able to certify that information for you. After identifying an organization's beneficial owners, the credit union must verify each of their identities according to risk-based procedures. At a minimum, These procedures must contain the elements required for verifying the identities of customers that are individuals under CIP rules. In other words, the credit union has to subject each beneficial owner to its usual CIP procedures. If you recall, CIP allows you to use documentary and non-documentary methods of identifying your customers. But most credit unions insist on documentary evidence, such as driver's licenses. Does this mean that each owner of a business has to come in and present a photo ID? No. These rules allow two key differences from CIP. One, the credit union can obtain personally identifying information about each beneficial owner from the organization, not necessarily from the owners directly, as long as the credit union has no knowledge of facts that would reasonably call into question the reliability of such information. Two, the credit union can use photocopies or other reproductions of the documents. The certification form alerts the person signing it that, quote, the financial institution may also ask to see a copy of a driver's license or other identifying document for each beneficial owner listed on this form. So you can point to that language if there's any reluctance to provide the copies. Credit unions must have procedures for maintaining records of all the ID and verification information collected. ID-related records must be retained for 5 years after the account is closed. ID verification-related records, in other words, CIP records, must be retained for 5 years after the record is made. As I mentioned earlier, to be on the safe side, just keep it all for 5 years after the account is closed. Before we sign off, I want to stress the League's Compliance Specialist program. We have a team of trained compliance specialists around the state who work with our legal affairs attorneys to provide hands-on compliance help to credit unions. We have two parts of that program. The Partner Program gives credit unions regularly scheduled compliance support for a set annual fee, and credit unions that enroll share a compliance specialist with other credit unions. That specialist is hired, trained, and supervised by the League. It gives you an experienced compliance staff in your credit union at a fraction of what it would cost the credit union to hire a compliance officer on its own. Second, we offer a la carte services. You can arrange to have a compliance specialist work with you as needed according to your own priorities, needs, and budget. We offer an extensive list of focus areas, but you can customize a program that works for you. Popular services include the annual BSA OFAC independent testing, ACH annual reviews, policy reviews, help preparing for an exam or correcting issues found in an exam, or anything else compliance related. For information on the Compliance Specialist Program, reach out to me at the League. If you have questions on BSA, OFAC, or any other compliance issues, please let us know. One of the benefits of League membership is that your credit union's staff, management, and volunteers can contact the Legal Affairs Department anytime for compliance information. You can call the League's 800 number and speak with any of the attorneys in the Legal Affairs Department, or you can email us, and one of us will reply usually the same day. Reach out as often as needed. There's no limit on the number of compliance questions we'll help any of our credit unions answer.